Hi, everyone. Thanks for joining on time. We'll just wait for a few moments before, a few more participants can log in. Thank you. All right. I think we can kick off. Good evening, good afternoon, wherever you are, depending on where you're in Singapore or India. Welcome to the webinar on the role of hedge fund investing in the alternate space. We have a very interesting agenda today. And before I jump right in, I just want to share a few quick disclaimers. So all the information in the webinar is for general reference only. Making it available through any marketing or other product information does not qualify as or solicit a sale or recommendation of the product. If you wish to receive a solicitation or recommendation from us, please contact us where relevant and go through the suitability assessment before transacting. We'd also like to share that the contents of the webinar have not been reviewed by any regulatory authority in Hong Kong and Singapore, and you're advised to exercise caution before investing in the product. You should not invest in this product based on the information on the webinar alone, and if you're in any doubt, you should obtain professional advice. We'd also like to re-emphasize that the webinar is meant for accredited investors only. So in case you do not qualify for that as per the MAS guidelines, request you to drop off at this moment. So jumping into the agenda for the webinar, so we would start with, building a case for hedge fund investments, the 2023 outlook on hedge funds, and insights on the top performing funds on the Kristal platform, followed by a Q&A session. At any point during the webinar, if you wish to ask a question, you may use the Q&A tool at any point of time, and feel free to write into us at support.Kristal.AI for any other queries. The webinar is going to be recorded, so we can start the recording now. So going back into 2022 and, one of the most perhaps interesting years from the perspective of someone who's looking at the markets, but not for investors. We've seen pretty much all the, large cap, mid cap indices been in the red, both across fixed income and equity. It's been a bloodbath, with the S&P 500 down to the tune of about 19%. The NASDAQ, which constitutes the big tech names, bled the most at 33% down. Markets across Europe have also been down to the tune of 12 to 15%, including China, of course, and Japan as well. In fixed income, the Bloomberg Aggregate Index was down about 13%. So pretty much gold, oil, and commodities were the only, mainstays for 2022. But despite this, what is the sharp contrast is the HFRI Composite Index, right, which is down just close to 0.7%. And this tells a strong number for a traditional 60-40 portfolio were to build in a hedge fund component in the allocation. So let's take a quick, primer on the kind of hedge funds that we'd be referring to during the course of this webinar. So long short are the most popular ones, which pretty much take positions in single name investments, both on the long and short side, thereby reducing their net exposure to the market. These could be in the nature of credit or equity. The next most popular or rather well-known are the global macro hedge funds that attempt to profit from broad market swings caused by political and economic events. Relative and arbitrage essentially seek to take advantage of price differentials between related financial instruments. Event-driven arbitrage, which essentially tries to take advantage of stock mispricing, resulting from corporate events. Quant funds that use advanced mathematical models and quant analysis, to build trading positions. And multi-strat, which pretty much straddle across all of these, bringing in a variety through either long, short, relative value, event-driven, or macro. So let's take a look at what categories of funds did well and, of course, lost in 2022. So as you can see, the equity long short suffered the most. Earnings were impacted, while earnings themselves were not as bad, but the macro crosswinds have impacted equity long shorts the most, down 13% year to date in 2022. Global macro and multi-strat were the best performing categories with close to 12 and 2% positive, right? So this pretty much tells us that the trend has been strong with certain categories of funds. I'll now jump in and introduce our speakers today. So first, I'll take this opportunity to introduce Philip. Philip Vanderwin is Head of Business Development at Antarctica Asset Management. He has strong experience in the corporate finance space, and prior to this has also founded an organization named Wingfield, where he was again fundraising for venture capital funds, a very big veteran in the hedge fund space. Ashwin Patravali, who is the lead financial products at Kristal.AI, has over 15 years of experience in the financial services. Prior to Kristal, he was with JP Morgan and has taken on multiple roles in the technology and financial product space. So before I go over to our panelists, I'll run a quick poll question here, and feel free to put in your entries. So, do you currently have allocations to your investment portfolio in hedge funds? So, very interesting mix. About 45% have shared yes, and 55% have said no, which of course means that there's a fair bit of value that the 55% can take from this. All right. So what were the big trends in the hedge fund space? And while I get into this, I'll bring in Philip, to kind of comment on what we've seen as the strong tailwinds and headwinds for the hedge fund industry. Yes, so while we've seen macro and multi-strat do well, any thoughts on what you think kind of contributed to the best performance in these two categories?
Yes, thank you, Gautami. Good evening, everyone, and thanks for attending. I mean, look, hedge funds, as a general rule, tend to thrive in environments with a lot of uncertainty, environments with a lot of differentiated opinions. And within the hedge fund space, the two strategies that benefit the most are macro and multi-strategy. I sort of dig into that a little bit deeper. If you think of multi-strategy funds, you have to almost call them multi-PM platforms. So what it means is that these organizations typically have many PMs all participating in a bigger fund where they have a certain allocation of risk-adjusted capital given to them, and they trade that in multiple different strategies. So one of the reasons why that works well in an environment a lot of volatility is because it is less dependent on the absolute know-how of one single person or one team that has it more right than anyone else. So that gives you a more balanced outcome, and that's also what you see in the results that Gautami showed earlier. Specific to macro, it sort of takes it a step further. It has that same benefit because a lot of the macro funds typically will have a multi-PM platform approach as well. But on top of that, macro can be effectively market agnostic, if you can call that. A macro fund can be long the dollar in the morning, short the dollar in the afternoon. The same thing can have a particular opinion on rates that changes throughout the day. And that gives them flexibility that is difficult to replicate by other organizations and other types of strategies. Gautami?
Right. We also saw that bigger hedge funds did better. We saw that there was a talent war for the largest names, which fought hard to retain best talent. And I think that's been pretty much the case why least number of startup hedge funds also set up shop in 2022. We also saw that equity hedge funds face the largest outflows. And I think it was the impact of earnings, definitely, because these strategies pretty much focus on fundamentals, which took less of a precedence over macro last year. Anything you'd like to add, Philip, on your sense on the trends in 2022?
Yeah, I think, look, the first point, equities seeing outflows. probably a combination of outflows combined with negative performance, and then people being probably rightfully scared to a certain extent by what they read in the press, whether it's information about geopolitical issues that are happening all around the world, China, Taiwan, what's happening in Europe with Ukraine. I mean, it frightens people, and it all happened very rapidly, very consecutively. So people pulled out, and that's a normal reaction. Your second point on the startups, it's true, it's probably not been the most fertile ground for new hedge funds to start. And you're right. I mean, people have a choice nowadays with more and more of these multi-PM platforms. If you're a very good trader, maybe you're better off going to one of these multi-PM platforms where you can really focus on what you do well, which is the trading part, and not have to worry about all the administration that comes with setting up your own business. So all kind of explainable. And yeah, I think the bottom line of this slide for me is that hedge funds will overall benefit from this environment, and that benefit will be clearly visible in your portfolios.
Right.
Hey, Gautam, just to interrupt, I think we just got some feedback. Philip, I think maybe someone mentioned it's not too audible. Maybe if you just speak a little louder. Just one comment from the.
I apologize. My voice is not the strongest, but I will do my best. Yes.
Sure. Thanks.
Sure. I think we'll also take the next poll question now. In terms of how much would you allocate to alternatives as an asset class? I'd like to qualify here that alternatives include hedge funds, private equity funds, and real estate funds. So, do factor that in your responses. All right. So we've seen, so about 76% of the respondents have said 10 to 25%, followed by 12% saying it would be less than 10% of the allocation, and a small percent saying 25 to 40 and 40% and above. So let's look at how the case for hedge funds can be built into a stock bond portfolio. And for this, I'll go over to you, Ashwin, in terms of sharing,
Yeah, sure.
Where it comes in. Yeah.
Thanks, Gautam. I mean, look, I think there's no right or number in terms of what that percentage allocation is. And, Gautam, you highlighted, in the return slide, obviously traditional asset classes, such as stocks and bonds, clearly underperformed in 2022. And on the contrary, hedge funds did relatively much better. And that's precisely what you'd expect from active managers to sort of generate that alpha when the rest of the market is struggling. And we think about it, until 2022, and obviously in an era of loose monetary policies, low rates, a lot of the assets had inflated up, and it was very easy for investors to sort of eke out, probably double-digit returns, right, without any sort of active management. Of course, a lot of that has changed. We are completely in a different era in 2022, and with the macro headwinds, be it the sticky inflation, geopolitical tension, and obviously the central bank action on rates, they've definitely had an impact on these traditional portfolios. So definitely, there is a case for hedge funds, and as you obviously mentioned in the poll, that an allocation of anywhere between 10 to 25%. It seems like a good number that many of you mentioned. And really, the key benefit is diversification, right? And this is a chart that we pulled out from a recent JP Morgan report, which clearly illustrates, adding some allocation to also, of course, in this case, they've put 30%, does help decrease the overall sort of volatility and, boost the risk-adjusted returns of the portfolio. Moving on to the next slide, again, this is an interesting one, which talks about the stressed environment. So what you see over here is a correlation of the hedge fund industry or returns of the hedge fund industry versus the returns of a 60-40 stock bond portfolio. And you can see over here, typically when markets are stressed, whether it was currently obviously what we had in 2022, or whether it was in the GFC or COVID, they typically exhibit a closer to zero or even negative correlation to the hedge fund industry. So again, we are in a challenging time where volatility is heightened. And so introducing hedge funds into your portfolio definitely helps reduce the overall vol and boost the risk-adjusted returns. On the next slide, look, I think this is a bit more kind of showing you a dispersion that not all hedge funds are the same, right? So this is a bit of a correlation matrix between different asset classes, right? So of course, you've got the standard traditional ones like equities and fixed income and gold. But even within the hedge fund universe, you can see that a macro hedge fund obviously has a different correlation to, say, a multi-strat strategy sort of fund or a long short. And this is just good to know that not all hedge funds are same or similar. And so, when you even allocate within the alternatives universe and you pick a certain category of, say, multi-strat and versus macro, they actually can exhibit a very different sort of return profile, which will benefit your overall portfolio. Philip, I'd love to kind of have you also opine and provide your thoughts here on this.
Thanks,
particular. Yeah.
Yeah, I mean, look, this slide and the previous ones, I mean, hedge fund investing is like so many things. It's no different than what you would do in your traditional asset classes. You're not going to put 40% of your money into a single stock either, or into a single market. It's no different with hedge funds. Hedge funds is a broad category with lots of different strategies, and we're only highlighting a few here, but there are quite a few strategies and sub-strategies, and so the trick is to build a portfolio over time. Now, you don't necessarily want to have an over-allocation in terms of number of funds, but by having, let's say, a starting point with a good multi-strategy fund combined with a global macro fund, and then you start adding maybe some long-short equity, and before you know it, you have a really nice balanced portfolio that will have, like you said, a differentiated return profile, which will help across cycles, not just in a particular year. I mean, I know it's easy to now look at 2022 and sort of say how bad markets have done, but there will be times where markets do well, but hedge funds still play a role, maybe a differentiated role, or different drivers, and maybe the point to make here is the availability of talent across all these hedge funds is amazing, because they no longer have to compete with the traditional, employers, which were in the past the banks. The banks were the big sort of employers of talent when it came to trading specifically. Now these people find their way to hedge funds. That's the way it is.
That's right.
Yeah.
I think there is one question maybe we could take at this point, which says, hedge funds are good in terms of mid to high single-digit return, which was good in a low rate period. But given that fixed income is already at 5 to 6, will hedge funds reach a high single-digit or low teen to keep the spread over fixed income? Do you want to take
I mean, I'm happy to take this. This is obviously a valid question, and a normal reaction to what we're seeing out there. But the strategy we're talking about are all strategies where you can expect easily 8 to 10%, and in the case of macro, you can probably expect 15% returns. So, as I mentioned yesterday to Ashwin and Gautami, it's 5%, of course, looks very attractive, especially since we haven't been there for a long time. But the hedge funds will increase their returns equally. So you can expect a hedge fund portfolio to kind of yield 8 to 10% with half the volatility of what your equity book does. So I would still advocate investing rather than sitting on cash. Now, there's other ways of deploying your cash, but sitting on cash, the nice thing is it doesn't detract, maybe, but it's not going to be a driver even at 4 or 5%.
Sure.
I guess the other question we also have here, just before we take this call, and I think one of the flack that the hedge fund industry obviously has had is generally on the higher costs, right, Philip? And one of the things that hedge funds have had to justify is why would someone want to pay that higher sort of fixed or running or performance fee? What is the sort of trend? I mean, I've seen that these fees have been coming down, and hedge fund industry has sort of moved away from the 2 and 20. Some sort of, at least the bigger ones I know are getting probably more expensive, but I guess the newer ones tend to be a little bit more cheaper. Yeah.
Let me first, obviously, for the sake of the audience, say that I'm very likely I'm biased here, but I don't necessarily look at it that same way. I mean, something can be expensive, but in the end, you need to look at what it does for you as an investor and the returns that it generates. It's almost immaterial what it costs. It's what it does for you as an investor. And when you have funds like Global Macro last year yielded between 20 and 50% in the portfolio with the funds that we were invested in, you know, if they've increased their price, so be it. I mean, they're still making an incredible amount of money for us. So there is obviously a trend, a dual trend. On one hand, the smaller, newer funds that have been through difficult times tend to be under fee pressure, and they will come down with their fees. But the very large organizations, the multi-strategy funds, the large multi-PM platforms, they typically have no issues with finding new investors. On the contrary, they close the doors to new investors. And if you look at the offering that we have at Antarctica, and then sort of in reflection what Kristal offers in that space, all of these funds are either closed or close to being closed, and have more demand that they can offer. So the fact that they're expensive, yes, it's a supply and demand element, but also the fact that they actually deliver returns to their clients, not just once, but consistently.
Yeah, sure. That's well said, Philip. I think there's one more question maybe we could take. Will it be better to invest through fund of hedge funds or into single hedge funds? I think maybe I could just take that in the sense that multi-strategy have pretty much taken over the fund of hedge fund market, given the fact that these are multi-PM platforms and do allocate capital depending on how and when each sub-strategy is more favorable. So the cost layers are in fact embedded into one single fund. So it might be a better idea to take a multi-strat or a multi-PM fund versus a fund of hedge funds. I guess we'll move on. And that's the third poll question. And this is the last one, we promise you. Which hedge fund category is likely to outperform in 2023? The options are macro, event-driven, quant, long, short, and credit. All right. Okay, so about 38% said multi-strategy, 25% said event-driven, and 19% said credit. Equity and macro were about 13 and 6%. All right. I think with this, we will just jump into our outlook for 2023 and what strategies you could look at in this phase. So I'll ask Ashwin to step in here and cover the outlook.
Yeah, no, I think it's interesting to see that poll result. I think fairly mixed, I think a little bit more skewed towards multi-strat. But look, I think, going into 2023, volatility is still your friend. And active managers or those obviously are a lot more nimble, are likely to find opportunities to generate that positive return. And so you can see on this chart, again, something we pulled out from a JP Morgan report, is that across asset class, in fact, most of them, the blue chart, which is 23 balls, shows that there is obviously a spike or slightly higher number than the prior year. So that's an important point, because as even Philip mentioned earlier, volatility, uncertainty definitely is a driver of the ability for hedge funds to generate that positive return or generate that alpha. Going into some of, I guess, specifically where we think, obviously this is up for discussion, but just building on some of the themes from 2022, Gautam, just go on the next slide. Definitely macro, we think, will be a theme that will continue to be relevant. Of course, we expect returns to normalize. Of course, they've had a blowout year in 2022, as Philip mentioned. But some of those easy trades that were already realized, whether it's the short bond, short equity, long dollar, I think some of that might not generate the same sort of return that 2020 did. But however, as a category, they are still well positioned because they're in the ability to take directional views and be tactical, right? So I think whether it's on the rate or FX side, I think macros will continue to do well. Look, we've talked about multi-strat because they're a multi-PM model or a fund of fund model. They are able to poach some of the best talent on the street. And then as a result, they can run different pods or different sort of strategies under their master fund. And I think we've seen generally that the flows in the industry have sort of started moving more towards the multi-strategy funds that, of course, are much bigger. And of course, within the equity space, we expect there will be a dispersion in asset prices. And of course, with that dispersion, then you have some of the quality portfolio managers who can identify that sort of long short view on underlying companies and generate again alpha from that. So these are sort of the broad themes we think will do well. But Philip, would love your insight if there's something specific that or a certain strategy that's not covered here, if you want to add further onto these. Philip, you're on mute.
The outcome of the poll was interesting because it sort of it's a little bit against the grain, but that might actually not be a bad thing. The lowest expectation was on global macro, which we would actually put in one of the highest categories ourselves, because I do think that yes, maybe some of the fat has come off in 2022 already. The uncertainty in the economy stays for multiple reasons. And as long as that stays, these guys will continue to make money because they can be super, super nimble in allocating money, in literally in trading across different asset classes, across different opportunities, and they will extract value a bit more than what I saw from the poll, to my opinion. An interesting result I thought was the event-driven category, which the poll showed to be high expectations. I tend to agree with it to a certain extent, because they're, in times of crisis, there's always great opportunities for mergers and acquisitions. So that will be a positive influence for that strategy. Where I'm a little bit concerned for that strategy is indeed those rising rates, because a lot of these events can only take place with the use of leverage, with the use of borrowing, and that of course has become more expensive. So will we see as many transactions as we had hoped for? Maybe, maybe not, but will they be as juicy as they could have been at the zero rate environment? To be seen. So it's a mixed bag there. It's not a clear-cut outcome there.
Sure. All right. I think the next section is we'll be covering a few key products. Before that, just to give you an overview on, funds on the Kristal platform, both open, close. Today, I'll just ask Ashwin to cover the names.
Yeah, sure. So this, obviously a lot of you clearly are on the platform and have visibility on many of these funds. So look, these are what you see over here essentially is the most recent curated list of hedge funds that our investment committee has reviewed for Jan. So as you can see, we've got the different buckets that we broadly covered. Apart from, I think, two of them, I think those are not for open. I think the rest are all open. And, I think the key point over here is that we focus on ensuring that we get the best in class for each category. So it's not so much about bringing every single fund that we have on the platform, or rather what we can get access to. And qualitative parameters, and obviously a gap analysis in terms of whether that's already there, whether we need to add something additionally on the platform, and an overlay, of course, from our investment committee before we bring this on. So what you see over here is actually a curated list that we've vetted. And of course, what we're going to do now is talk specifically on a couple of these funds, and these obviously are the ones that are on the Antarctica feeder platform. I'm going to hand it over to Philip to cover 4 funds, which is the Antarctica LMR, Antarctica JGM Moore, Antarctica 0.72, and Antarctica. Did I miss one? Brevin, sorry. Yeah.
Yep, Brevin Howard, yes. All right, so obviously each of these funds probably warrants a longer call than the amount of time we have set out here, but then we maybe focus on why each of these funds may have a place in a portfolio. and what they do in general. So LMR is a relatively large organization, been around for a long time. They have a multi-strategy fund, and they also have this fund, which is LMR Alpha Rates Trading Fund, which is, in terms of the strategy, a fixed income arbitrage fund. And so what they do, what they focus on is to find trades where there's opportunities that are non-directional by trading, for instance, across the curve, short-term versus medium-term and so forth, and picking up very small discrepancies, doing that a lot and with some leverage, notional leverage, that is. Now, the nice thing about this particular product is the way I look at this is that it's effectively, think of it as a fixed income replacement fund. So rather than thinking of it as a hedge fund in itself as an asset class, you could almost think of it as it has place in your fixed income portfolio. Yes, it's a hedge fund. It will typically yield you, call it 7 to 9%, in good years, quite a bit more, with higher volatility than your bond portfolio, but not much. And so this is a really attractive strategy that has great value in a portfolio because it's differentiated and idiosyncratic in its return profile. So it's going to make you money when lots of other asset classes are not necessarily making money, including fixed income.
I think what I found interesting about this, Philip, was that it hasn't had a negative year since inception, right? This particular strategy.
No, I mean, that doesn't mean it's not fallible. They will have negative months, but again, they are not really concerning themselves with betting on whether interest rates are going to be hiked or not. They're really just looking for arbitrage. It's a relative value play, and so when they see things being mispriced, when they see certain trades, they will immediately act on them. It's very short-term kind of trading. So hold it for like a short holding periods to medium term. That's typically what they do. And as I pointed out, it does have no leverage on.
We move to the next one.
Yeah, I guess in the interest of time, we probably want to cover all of them.
So it's
Brave and Howard Master Fund. First of all, for those who don't know it, it's Brave and Howard has been around for a very long time, since the 90s, I believe. Has been very successful over many decades, and one of its founders is still within the organization, Alan Howard, even though the day-to-day is now taken over to a team of people rather than a single person. Brave and Howard Fund is really one of those traditional global macro funds that will trade across many, many different opportunity sets, and has, off the top of my head, something like over 100 or close to 100 PMs, so portfolio managers, that will all trade separate books, separate, distinct opportunities, whether it's on the FX side, whether it's on rates and different strategies. So that gives you, think of it almost like a multi-strategy within the macro space. It's got a great pedigree, and most of all, and I think probably the key thing to remember here for this fund, it has one of the best risk managements in the industry. Very strict, very good, very seasoned people, and it shows in the results. Now, again, the last couple of years have been very, very generous to them. If you go back in time, they've had a period of time where they didn't perform as expected. When I say that, they sort of flatlined, if you will, didn't make a lot of money. It was for two reasons. First, because macro for a while wasn't that attractive as a strategy. It was different from now because the whole world was thinking alike and markets were just going up, so there was not much for them to play around with. But second of all, they had grown very, very large, and what they did is they reduced their assets under management again, and now they're back to being a little bit more nimble and controlled. So yeah, again, this annualized return close to 8%. It's a very attractive fund, and it will add value to your portfolio throughout cycles.
And I think what's also interesting is the negative correlation to both equity and fixed income, right? Which is
Yeah,
why last year has been, stellar for them.
yeah. But that I would say is, and we probably see it again in the next slide where we cover JJJ fund. Global macro tends to be a little bit agnostic of what's happening in markets, again because of the relative value play. So they're not directional. So JJJ is something that we at Antarctica are quite proud about, because it's a fund that you will literally not find anywhere else, for the simple reason that it actually, as you can see from the name, the full name of the fund is called JJJ More. It sits within the confines of More Capital. More Capital, for those of you who have been around for a bit longer, used to be a very famous hedge fund platform, ran a number of different funds and different strategies. And I can't remember the exact date, but I would say easily 5-6 years ago, decided to become family office and return money to all external investors, with the exception of this particular fund, which they ran internally. And just to give you an idea, it had, prior to Antarctica becoming an investor in this fund, it had 4 prior to Antarctica. The largest investor being the founder and owner of More Capital, Louis Bacon, with 950 million invested in this strategy of his own money. So they have money at risk here as an organization. This is slightly different from Brevin Howard insofar that it's multi-team, but it does have a PM that sort of controls the whole organization, and very nimble. And what is differentiated from this fund, if you say from Brevin Howard, these guys really focus on inflation. So inflation is the key driver of a lot of their trades. And the funny thing is that you would expect, of course, last year to be stellar, and it was. But they've been around for a number of years, and even in the times where there was no inflation, they still managed to make a lot of money. Again, idiosyncratic in its return profile, and therefore additive to a portfolio of what is traditionally maybe 60-40, but probably should be including some alternatives. I don't know if you want to go to the. So as you can see, higher annualized return, obviously slightly higher vol as well. The largest drawdown is about 15%. And that can happen when there's dislocations in very sort of concentrated positions they have, but they usually recover quite well. If you look at their overall performance, I can check on my end quickly, but I think that they've only had 1 or 2 negative years in their history. If you bear with me a second, I'll let you know. Yes, they had a negative year in 2014. That was the only negative year they ever had. So that's not bad considering this fund has been around since 2000.
Sure. Should we move over?
Yeah, please do. Then we can take some questions. Probably also always interesting. The final one is a multi-strategy fund. 0.72 is probably, aside from Brevin Howard, is also equally well known, if not even more well known. Used to be called SAC Capital. It had to reinvent itself because many years ago the fund was involved in some accusations by the SEC which were resolved, but as a result they rebaptized themselves as 0.72. Launched initially with money of the owner, Steve Cohen, who effectively had about $10 billion of his own money at work in this fund. Still there, probably has grown in the meantime, and opened up to the public, I would say, 5 years ago. This fund is multi-strategy, which we discussed before. But if you have to sort of look a little bit deeper, they derive most of their returns from the traditional long-short equity space, be it that they do this in a market neutral way, so non-directional, but still long-short equity would be the largest driver of performance within. I don't know if you remember in the beginning of the presentation that Ashwin showed sort of the different buckets that these multi-strats play in, and they have an overweight to long-short equity. So now, where we are in the current environment, having seen significant drawdowns in many different markets, this actually could be a really like another tailwind, if you will, for this type of fund, because not only is it multi-strat, multi-PM, but if one believes that markets will at some point correct, they will also benefit. Again, to the returns, you will see these returns are quite significantly better. As you can see, annualized returns of 21. I would like to make a side note on this number. One of the reasons why these numbers are so amazing is that this fund goes back to early 90s. And you have to understand that back in the 90s, the hedge fund industry was very different from what it is today, and mainly because there was very, very few players. So the margins were very large because there was very few people chasing the same deals. Today, you have a lot more money in the market, many more players, a lot more hedge funds. And so the ability to make money on trades has diminished somewhat from what was possible in the 90s. Let's be clear on that, which is one of the reasons why these annualized returns are high. I would say if you invest in today's market, this should more be normalized to probably a 10 to 12% expected return. Still very attractive.
Right.
And here the drawdown is 2008. When you look at the cumulative drawdown, that's a clear effect of what happened in 2000. And I would say it probably makes sense to pause here for a moment and see if there are questions.
Sure. I think we do have a few that have come in. Okay, so what are the fees for investing in these funds?
Ashwin, do you want to take that one? Or
Yeah, look, I think so I mean, each of these funds obviously have their own sort of management fee and performance fee. So I don't think we've showed this over here, but I think if you go into the Kristal portal and you look at the Kristal page, you'll get to see what the management and performance fee is. And look, it varies, right? So you know, some are 2 and 20, some of them perhaps have a higher performance fee, some have a lower management fee. But what is key to note over here is that the returns that we have put up on the Kristal portal, at least as part of the feeder fund fact sheets, those are all net of fees, right? So all of the fees are accrued within the NAV, and that's what's reflected in the performance numbers. We're also going through Antarctica. So Antarctica as a feeder has its layer of fees. Again, that fee will vary by the fund we go on, but typically it's 0.55% per annum. So that's over and above the actual fund strategy fees. Again, the fund fees plus the feeder fees, this is all sort of netted off in the return numbers that you see on the fact sheet.
And maybe to add to that, one of the key things here is obviously people will rightfully say, why all these different layers? A lot of these funds are, first of all, not open to investors, and definitely not open to the general public, or even if you are professional investors, all of you, the minimum investments in most of these funds can be $10 million. And so that precludes many investors to even participate in these funds, because even if you have that kind of money, are you going to put it in a single fund? That then remains a question. So by working with Antarctica and Kristal, who partnered up here, we are able to reduce the minimum investment size significantly, allowing you to build portfolios of hedge funds without the need of it being a multi-billion. So I think that's part of.
Yeah, no, I think that's a very important point. I think with the hedge fund industry, getting access is very key, right? And I think through the Antarctica platform, that works.
Yeah, and I would say added from our perspective, and again together with Kristal, is obviously also the fact that we do our research, our homework, our due diligence. So we have, as a firm, a curated approach. So our goal is not to onboard 1,000 funds. We actually have 40 funds that we offer, and of that, 5 have been selected by Kristal to partner up with us for. So it's very dedicated, very focused, and supported by research and due diligence. So all of that, of course, is what you end up paying that little bit extra for.
Yeah, and I think the fact that we using a partner platform like Antarctica also gives us access to some of the information in terms of the manager reviews, in terms of what the PMs are thinking. And of course, that is just talking points that then we can obviously share with some of our customers on a need-to-know basis. Yeah. Just want to clarify, Philip, there's one question on this cumulative drawdown. What are you referring to max drawdown over here? What does that mean?
So yeah, that's the cumulative drawdown is the maximum drawdown that the fund has had since inception. So in this particular case, the slide we're looking at, 0.72, the biggest drawdown they've ever had was 23.7%. Now, as I pointed out when I finished, this is very likely going to be 2008. That's what would have happened then. But you know, that's if you go to the other funds, some of them were not around in 2008. JJJ wasn't. Van Howard was, and LMR Affiliates was also not yet around in 2008. So, but if you want the maximum drawdown in the past 3 years, I'm sure I could compile it and share that with the team at Kristal and then get it back to you. But I don't have that here on the top of my head.
Sure. And also just on loss deviation, what does that mean?
So that's the standard deviation from.
Is that standard deviation?
The media.
Okay.
Yeah.
Okay. So just volatility. So wait, you have analyzed vol and then you have loss standard
No,
deviation.
but it's volatility on the negative side.
On the negative side. Okay.
Yeah. So if you take only the negative months and then look at the volatility of those.
The downside deviation is what you're.
Yeah. Downside deviation. Correct.
All right. I think there's one question on 0.72 where they would like to clarify on the management team. Is it the same as SAC?
Yeah, so again, the firm had to reinvent itself in sort of, call it 2010, 2012 period, then managed privately about $10 million of Steve Cohen and then reopened to outside investors in, I believe it's 2017, on top of my head. But the team has always remained the same. Don't forget, these are multi-PM platforms, so these teams have a lot of churn. The senior team members, I mean, Steve Cohen has been in place since day one and still there. But of course, the PMs themselves, they rotate based on performance, based on output, and many other factors. Some of them get poached away by others, and they hire them from other people. It's a bit of a musical chair in the multi-strategy business. That's what it is. But the management team, I would say, by and large, is similar.
Sure. There's one more where would Kristal Antarctica know the depth of the team, that is the team size of employee strategies? So we do have some information on this, on the decks that, the fund that Antarctica has shared. While, of course, this some of this information is only in terms of numbers and not names. But we would be happy to share that with you separately after the call.
And again, keep in mind that these numbers obviously also fluctuate quite a bit, especially as AUM grows. And most of these funds have, these 4 funds have typically all grown their AUM over time, so they would have higher and higher.
Yeah. So Philip, I guess just that one question. So if we want to get an extract of the maximum drawdown in the past 3 years, you said that's something you have separately that we can get, right? For these 4 funds?
Yeah, I can run those numbers. I mean, it would take a little bit too long to do it on the fly here on the call.
Yeah, no, that's fine. I think
of course, I have those numbers.
Right. Okay. So yeah, I guess we can get that.
Sorry, if you can share your name, who has asked this question on maximum drawdown, we can surely share this data with you. I think this is an interesting question, Philip. Knowing the history of Steve Cohen at SAC, are you comfortable with them?
Yes. Short answer is yes. Otherwise, we wouldn't be invested in, we wouldn't offer it on our platform by any means. You have to understand that Antarctica, we have an institutional investor. We have been in the business for 22 years. I think we can pride ourselves on the fact that while we have had market losses, we have never been invested in funds that have had any blow-ups. So no Madoff, no Peloton, no Amaranth, and so forth. We have done a lot of work on this fund, as you can imagine, and we only onboarded it after really doing deep due diligence at every possible level. What happened at SAC back in the time, as one would say, there's probably no smoke without fire. So was there something? Yes, there must have been something. They settled. And usually when people settle, that's for a combination of reasons, but partially also because it also allows people to move on. And I think that's what Steve Cohen opted for. He wanted to move on. He wanted to get rid of this problem because it made no sense to drag on in lengthy legal battles that ultimately only make the lawyers wealthier. That said, he then restarted his fund by adding probably more layers of risk management and controls than any other organization in the industry, to an extent where they even hired and still have ex or former FBI people on their payroll, making sure that traders are staying within the realm of what is allowed and stuff like that. So it's really quite stringent within 0.72 to trade. So the chances of that ever happening again within that organization are probably even lower than anywhere else in today's market. That's our belief. And we have done and continue to do our due diligence on these funds on an ongoing basis. So yes, we feel confident and comfortable to be invested with Steve and his team.
Right. Okay. I think we are towards the fag end, but a few more questions coming in. Okay, so we'll take one which says there's a question on Millennium. How much advance notice can the funds typically give for capital calls? And another question is, can you speak about Kristal's fraud filters while reviewing such funds?
I'll take the first part. I'll take the first part, which is easy because it's a Millennium has imposed that on everyone in the market. It's 30 days. So Millennium gives 30 days, which means that we try to send it out on the same day or the next day. So you will have 20 days at the Antarctica level.
That's right. Okay. In terms of fraud filters, actually, I think one of the, the due diligence process at our end, of course, is, doing a deep KYC on the fund, who the administrators are, custodians are. There's, a review of the PPM subscription documents. Of course, a conversation with every single manager that we onboard on the platform. So these are some of the broad checks that, we have built in. While we think that, frauds, are not something that are very easy to sort of, kind of that can come across only through document review, but the process is very stringent. We do ensure that we understand the source of returns. We also look at audited financials for the last 3 years minimum to see, what has been the reporting on the P&L, especially on these hedge funds. So that's what we can say, on the due diligence process.
Yeah, and I think to add on that further, I guess in Antarctica's case, that's another layer that gets put in, right? Because as Philip mentioned, that they have their own layer of curation. So I think it's basically 2 checks and balances that we have.
We have a very senior due diligence team on top of the investment due diligence. We do operational due diligence, we do legal due diligence, and all of that is independent. Any of these people has a veto right, and they go very, very deep. They do reference checks, independent reference checks, not the people that they offer, but we go in the market. Now, it is very unusual for us not to find people that we know that can be references, simply put, because we've been around for 22 years. So if we can't find a reference very quickly, that usually is an alarm bell for us. So as an organization, we pride ourselves in the fact that our due diligence is second to none. And as I've mentioned before, it's actually reflected in the fact that we have always avoided these frauds. And as I said, it doesn't avoid market downturns, when markets go down, the funds can lose money, but at least we've avoided flows.
Sure. And I think we'll make this the last question. So can you elaborate more on the risk management for point 72?
It's a very broad question. I don't know if we have time for this on this call, but maybe the way to address it is that I show you something out of our research material, Gotami, and you forward it to the client who asked the question, because I'm not going to do it any justice by talking 10 seconds about it. So I think that's the best way to do it.
Sure.
Thanks.
Thank you. I think we're almost close to the end of the webinar. Thank you so much, everyone, for participating. It was a very interesting session from both sides, and we look forward to any sort of questions that you may have follow on in terms of either these funds or generally on Kristal as a platform. I wish you all a very good evening, and thank you.